Cast is now starting. All attendees are in listen-only mode.
Hi, good afternoon and a warm welcome to all. I am Ridul on behalf of Care Ratings. Welcome you to our today's webinar on corporate performance Q1 FY20. Appreciate your time in joining us for this webinar. Our speakers for today is Mrs. Kavita Chacko, Senior Economist at Care Ratings, and Dr. Rucha Ranadive, Economist at Care Ratings. The discussion is in form of a presentation which is visible on your screen. In case of queries, we'll be having a Q&A session at the end of the presentation. May I request Kavita to begin the session?
Thank you, Mridul. Good afternoon, everybody, and thank you for joining us in this webinar today. In this webinar, we have examined the performance of the Indian corporate sector for the first quarter of the current financial year based on the earnings reports of nearly 3,000 companies. In addition to the analysis of the overall performance, we have also looked into the performance of companies based on size to see if the performance differs across different size groups. Included here is also the industry-wise performance of over 60 sectors. Overall corporate earnings in the quarter ended June 19 has been muted. There has been a notable decline in growth rates of net sales and profits when compared with the comparable quarter of a year ago, which witnessed double-digit growth rates in both net sales and profits. Net sales growth at 4.6% in the quarter ended Continue. Sorry. Okay. Sorry for the technical glitch there. I shall start again. Okay. Coming to the overall corporate earnings in the quarter ended June 19, it has been seen that it has been muted. There has been a notable decline in growth rates of net sales and profits when compared with the comparable quarter of a year ago, which witnessed double-digit growth rates in both net sales and profits. Net sales growth at 4.6% in the quarter ended June 19 is nearly 9% lower than the growth in sales seen in the first quarter of the last fiscal year, while the growth in profit after tax at 6.6% is 18% lower than the year ago period. It need be kept in mind that 2018-19 witnessed improved corporate performance with growth rates of net sales and profits rising to a 5-year high. Overall growth in corporate performance continues to be driven by large corporates, that is, those companies with net sales greater than rupees 250 crores. And in terms of sectors, it has been the finance sector, namely private banks and NBFCs, along with pharma, healthcare, cement, and engineering construction, to name a few, that have seen growth in sales and profit in the first quarter of the ongoing fiscal year. On the other hand, auto and auto components, textiles, fertilizers, metals, capital goods, oil and refineries are some sectors that have seen a contraction in growth of sales and profits, which is reflective of the slowdown in demand conditions. In order to get a better perspective of the performance of companies in the quarter gone by, the underlying economic environment in which the companies are operating need to be looked into. The domestic economy has been going through a period of prolonged slowdown. Economic activity has been moderating in the last 3-4 quarters. GDP growth slowed to a 5-year low of 6.8% in 2018-19. There has been a broad-based decline across sectors with slowdown in private and government consumption, and investment activity is yet to see a meaningful revival. Industrial activity so far in the current financial year has been lackluster. During April to June 2019, industrial output growth at 3.6% has been lower than the 5.1% growth seen in the comparable period of last year. The lower growth in manufacturing output and the contraction in capital and consumer goods is reflective of the prevailing weak demand and investment climate in the domestic economy. Manufacturing output during the first 3 months of the current financial year has grown by 3% compared with the 5% growth during the comparable months of last year, while capital goods and consumer goods have witnessed a contraction in growth of over 2% and 1% respectively. Both these segments had witnessed growth of over 8% in the first quarter of last year. In terms of price levels, both the headline retail and wholesale inflation have been relatively mild on account of lower food and fuel prices. Prices of manufactured products too have been lower, which is reflective of the low pricing power of manufacturers and which in turn has a bearing on their earnings. The trade performance too has not been favorable. Both exports and imports have seen a contraction in growth rates this year compared with year ago. In the first 4 months of the current fiscal, export growth contracted by 0.4% compared with the 2.3% growth of year ago, and this can be largely attributed to the global trade and geopolitical tensions. The decline in imports, on the other hand, point to the weakness in domestic demand. The financing conditions in the domestic economy continue to be tight. The availability and cost of funds has been constraining company operations and investments. While the RBI has cut interest rates since February 2019 by a cumulative 110 basis points, the transmission of these rates by the banks has been limited to around 30 basis points. Borrowings from banks have been lower this fiscal. There has been a contraction in bank credit growth during April to August 2019. While the cost of borrowings in the debt capital markets via corporate bonds and commercial papers have declined consequent to the rate cut by the RBI, it is only the high credit rated corporates that have been able to raise funds via corporate bonds and commercial papers at lower rates. To put this in perspective, nearly 89% of the corporate issuances in July 2019 carried a rating of AAA. The rupee has depreciated in recent months with sustained foreign investor outflows from the domestic markets due to weakness in domestic economic fundamentals and global trade uncertainties. The rupee has depreciated by nearly 4% against the US dollar during the 5-month period April to August 2019. It can thus be seen that corporate earnings in the first quarter of 2019-20 have been constrained by the prevailing domestic and external economic scenario. Our assessment of the corporate performance for the first quarter of the current financial year is based on the performance of 2,976 companies over the comparable period of last year. This includes banks and finance companies too. On excluding banks and finance companies, the number of companies analyzed is 2,574. All these companies have announced their results on or before 15th August 2019. The aggregate performance of the 2,976 companies in Q1 2019-20 over last year, that is Q1 2018-19, shows that net sales and profitability of companies has grown at a slower pace when compared with year ago. In quantitative terms, net sales growth at 4.6% in the quarter ended June 19 has been lower compared with the 13.5% growth in the corresponding quarter of last year. Similarly, the net profit growth at 6.6% in the quarter of April to June 19 has been lower than the growth of 24.6% of year ago. Excluding banks and finance companies, the corporate performance shows a similar trend in terms of growth in net sales. Net sales of these companies grew at a much slower rate of 2.7% in Q1 2019-20 compared with the growth of 14.2% registered during the same quarter of last year. Profitability of these companies too has declined during the quarter. In Q1 2019-20, profit after tax contracted by 11.9% for these companies as against the 52.9% growth in the corresponding quarter of last year. Expenditure for these companies has grown by 3.6% in the quarter of June 19 compared with the 11.1% growth in the corresponding period of last year. The slower growth in expenditure can in part be attributed to lower raw material costs. This is in line with the wholesale price inflation in the manufactured product segment, which grew by 1.4% in Q1 of this fiscal, which is lower than the 3.8% price growth seen in the corresponding quarter a year ago. The wholesale price index based inflation in fuel and power too has moderated to 1.2% in Q1 2019-20, which is substantially lower than the 12.3% inflation registered in the corresponding quarter of a year ago, which has resulted in lower expenses by corporates towards power and fuel. Interest cost for corporates has increased by 12.4% in the first quarter of this fiscal has increased by 12.4% in the first quarter of this fiscal compared with 9.3% of last year. The borrowings by corporates has remained more or less stable as the bank credit growth in the manufacturing and services segment has grown by 9.3% year over year in quarter one of this fiscal as compared with the growth of 9.5% in the comparable quarter last year. Coming to interest cover has declined from 6 times in Q1 2018-19 to 5.3 times in Q1 2019-20. This is mainly due to the increase in interest costs. I now request Rucha to take you through the size-wise and industry-wise performance.
Thank you, Kavita. We shall now move on to the size-wise assessment of the industrial performance during the first quarter of the fiscal 2019 and 20. Herein, a sample of 2,574 companies, which excludes banks and finance, has been disaggregated according to the net sales of the companies during the quarter in 5 different categories. Large corporates with the net sales more than rupees 250 crore each dominated the overall performance with a share of 94% in the total sales of the sample companies. Barring the large companies, the all other net sales bracket indicated a decline in the sales during the first quarter of 2019 and 20. Growth in the net sales of large company was however lower at 3.5% compared with the 15.3% growth in the comparable quarter last year. However, these companies reported a decline in their profitability. The net profits of these companies declined by 11% during the first quarter of 2019 and 20 compared with the growth by 46% a year ago. The next net sales bracket of rupees 125 to 250 crore witnessed a drop in net sales by nearly 2%. Nevertheless, the profitability has improved over the last 3 years, with profits growing by 19.1% during the first quarter of 2019 and 20. In the size bracket of net sales below rupees 125 crore, all companies have registered decline in their net sales. While the companies in the net sales bracket of rupees 25 to 125 crore slipped into net losses, the companies in the lower 2 net sales bracket continued to witness losses and that widened during the quarter. We have presented here a snapshot on industry-wise performance based on net sales and net profits growth in the first quarter of 2019 and 20. As can be seen, majority of the industries have registered contraction in the sales and profits during the quarter. Finance investment, aluminium, automobile, textiles, fertilizers, steel and iron, refineries, electric equipment, metals, hotels and restaurants, diamond and jewelry, and oil exploration have registered contraction in net sales as well as profits. Steel, plastics, glass, pesticides and agrochem, public sector banks, sugar, telecom, tires and allied and power are some of the industries that witness growth in net sales, but the profitability of these industries have declined during the quarter. On the other hand, consumer foods, NBFCs, IT, logistics, paper, household and personal products, shipping, housing finance, retail, real estate, pharma and drugs are some of the industries that have seen robust growth in terms of both sales as well as profits. The performance of the broad sectors and industries has been assessed here on the basis of the growth in the net sales in the first quarter of 2019 and 20 with a year ago. Within the broad industry category, the sales in the automobile and related, capital goods, oil and refineries, and metals declined during the first quarter of the fiscal year 2019 and 20. 22 out of 62 industries have registered a double-digit growth in the first quarter of the current fiscal in terms of net sales, namely consumer durables, electronics, engineering, private banks, housing finance, retail, NBFCs, hospital and healthcare, trading, and consumer food, among others. On the contrary, 20 industries have registered contraction in their net sales during the quarter, such as passenger cars, trucks and LCVs, aluminium products, finance investment, and electrical equipment. In terms of net profit growth, automobiles, services, oil and refineries are some of the broad industry groups that witnessed decline in the profits in the first quarter of 2019 and 20 as compared with the improved profits in the comparable quarter last year. At the segregated industry level, 22 out of 62 industries have registered a double-digit growth in the net profits in Q1 2019 and 20, some of which are hospital and healthcare, trading, construction, cement, pharma and drugs, private banks, retail, housing finance, and consumer durables. 24 industries indicated a fall in net profits during the first quarter, such as rubber, power, oil exploration, hotels and restaurants, refineries, metals, steel, and fertilizer, to name a few. Certain industries have witnessed improved net profits during the quarter. The growth in the net sales of FMCG was seen mainly owing to the new product launches in the domestic product. The growth in pharma and drugs is backed by an improvement in the sales in the international market like the US and product launches by some players in the industry. Improvement in the NPA situation and rising net interest income has resulted in the better performance by the banks. However, higher provisioning of NPAs has pressured the performance of the public sector banks during the quarter. In case of automobiles, commercial vehicles volume declined by over 14% on the year-on-year basis on the back of curtailed lending by the NBFCs and lower rentals. Price hike in the passenger vehicle and two-wheeler segment due to new safety norms, higher insurance costs and higher inventories at retail level weighed on the overall automobile sales. The primary factor dragging the performance of the metal industry is the decline in the prices of metals that had an impact on the sales and profit margins. The slowdown in the domestic steel demand has constrained sales realization and pressure on the steel prices. In addition, the decelerating automobile sector and slower global growth also impacted the overall performance of the steel industry. In case of telecom industry, the price war continued to lower the performance of the telecom industry. The sales of the oil exploration have fallen due to the volatile commodity price realizations. The fertilizers industry's revenue have fallen due to delay in the sowing season onto the late onset of monsoons. In our view, the corporate performance going ahead will be contingent on the improvement in the underlying economic scenario. The government has recently announced a slew of measures to support the slowing economy. The second half of the year is likely to see some pickup in the economic activities aided by festive and rural demand, with monsoons turning into a surplus at a current 2% of the long period average. The Kharif output could be favorable, which in turn could lead to improvement in the rural income and demand. Thank you.
Thank you, Rucha, Kavita. Dear participants, we'll be taking a break of 2 minutes before we begin our Q&A session. In case of queries, you can please key in the slot provided. I repeat, we'll be having a break of 2 minutes before we begin our Q&A session. In case of queries, you are please requested to key in the questions. Thank you.
We have a question here from Sagar Shah. According to you, when will the FMCG sector show growth signals? Thank you for your question, Sagar. According to the Care Ratings Outlook, the consumer durables or the FMCG sector is likely to see a pickup in the second half of the year due to festive demand, improved standard of living, and change in lifestyles of the consumers. Also, the higher disposable income in the hands of the rural population on the back of higher MSPs for Kharif crops and with normal monsoons for the rest of the year. We have another question. Which top sectors would lead to earnings recovery in FY20? Well, we are expecting the recovery to come from fertilizers, hotel and tourism, pharma and drugs, healthcare, and FMCG and retail. We have a question here. Please throw some light on the performance of sugar industry. So we are actually expecting that the sugar prices will go up and there would be some range bound that we will see due to higher inventories that are with the government right now. However, growth in the prices can be expected once the new export subsidy announced by the government yesterday will start materializing. We have another question on the auto industry, that the industry has it hit the bottom level. So, we are expecting that the auto sector is not likely to see a turnaround in the near future. However, we are expecting that in the second half of the year, it could see a turnaround in with the various planned products launches, festive demand, and pre-buying of automobiles before the implementation of BS6 norms from on April 1st, 2020. We have another question. What are your views on steel sector? Currently, we are facing pressure on the prices due to slowing demand from user industries like auto and construction. However, we expect the demand for the steel to pick up in the second half of 2019 and 20 with a likely recovery in the steel demand from the construction and auto sector. We have a question. Real estate and construction registered a positive growth in Q1 FY20. What is the probability of this trend continuing in the subsequent quarters? We are expecting the real estate and the construction sector to grow at a steady pace in the upcoming quarters. It's mainly because the that there would be a uptick after the completion of the monsoon season in the construction activities that could lead to a steady growth in these two sectors going ahead. Another question. For the last three groups, your analysis shows a loss in the current quarter. Is it likely that though the aggregate is a loss in a given bucket, the aggregate is skewed due to a handful of high loss making companies? Well, we have seen that there has been losses across the various size groups of the companies. So there is no bias or there is no skewness which is coming due to high losses made by the smaller companies in our sample. It is broad based.
I think that was the last question taken up for the day. Thank you again to all the participants for taking your time out and being a part of this Care Ratings webinar. In case of any suggestions, feedback, you're most welcome to write to us in the comment box, which will be coming no sooner when the webinar ends in your mailbox. Thank you and goodbye for now.